Do you know Hanesbrands company name? No. But if I ask you, this Hanes brand, in reality, it consists of many, many other brands. Okay, I'll ask you like that. Who knows company like Wonder Bra, like girls, or Playtex, Champion, Bond? See, they have so many different brands under the umbrella. And the way they develop themselves is by buying new companies. Okay, so you know them. Now, the interesting thing that Hanesbrands, it was established in 2006 from the scratch. It was actually a spin-off, and there was a much bigger company which probably existed nearly 100 years. It's called Sara Lee Corporation, which has a lot of different departments in their business, and one of them was like clothes. So they like extracted that part of business from their business, and that's how Hanesbrands was born. Hanesbrands was born already as a big baby, okay, with a big capitalization. After that, it grew quite a lot as well, but you need to understand that they didn't start from scratch, okay. Now, when you analyze the business structure, they have about 74% of their sales, current sales, it's USA, or in United States, and only 26 is outside of USA. But if you read their last reports, you will see that that part of business is growing much faster. And probably next few years, we will see that like that part of business, like international part of business, will represent much bigger chunk of their businesses. Even in Australia, yes, correct. They recently bought some chain in Australia as well. So, and but the biggest area, it's in Europe. So if you look at the distribution, you can see that international part of the business, Europe, is more than like half. But you need to understand, like, it's like so many countries in Europe, okay, and they started there much earlier. But again, Asia Pacific region like has a lot of potential for development as well, okay, in this particular case. Now, another thing that they're quite diverse. They sell clothes to kids, men, and women. So, like, sometimes we analyze, like Chica, for example, they were mostly focused on only women. They didn't sell. When we look at some Asana brands, they sell only for kids. Whereas this specific company, because it has so many different brands, they cover all aspects of this particular business. And the good thing about also them that they design their clothes themselves, they manufacture themselves, and they distribute. And 74% they manufacture themselves. The rest of it, 26%, they outsource for manufacturing to somebody else. And if you look at the type of clothes, you can see like they have innerwear, you know, men's underwear, socks, like panties, etc., etc. Yeah, and they have also active wear, so it's like all sport goods. Okay, in this particular case. Now, and that's probably the next point. It's what they really like put this company aside from all other companies in that specific industry, apparel, because 89% of their business is B2B sales. So it's not like they have a lot of stores, like 4,000 or 5,000 stores, which they sell their product from, like, you know, so through the shops. No, 89% of the business is B2B sales. For example, they sell 20% of their sales comes from Walmart. So they sell to Walmart, and then Walmart sells it. About 15% of their sales level, it goes to Target, and probably 50% of their like sales go into 10 top customers. And from one point, it's quite good, because when you deal with one client quite a while, the cost of like this type of relationship is quite low, okay, because it's already adjusted. But if there is a risk here, if something happens to relationship, can you imagine that Walmart, for whatever reason, decides to pull this deal off, they're going to lose 20% of their business. and same with Target. Okay, so that's kind of, but I don't think it's going to happen because they have so many brands, and people probably would be looking for these brands in these shops. Now, another thing which distinguishes this specific company, that they're not like up-trendy company. They're not that expensive. They're trying to beat their competitors by putting a low price. And I presume if you go and choose like Nike or Champion, you will see the Champion will be probably a bit cheaper than Nike clothes or Adidas or like that. So they're putting somewhere in the lower, like level of prices for their specific product. Okay, now they have about 52 factories, and the interesting thing about factories is that you actually they have a shop at each factory, and local guys or people come and buy with discount at those factories, so you can buy cheaper than you buy it in the shop themselves. Now, from the wholesale level, they have 15 distribution centers in USA and about 29 international distribution centers in like Asia Pacific region, Europe, South America, and etc. 11% of their business is direct to consumer sales, and they've done through 250 outlets in US and online website. So it's very tiny amount of shops there. Even if we compare with Asana, which much lower in capitalization. Asana, I believe now capitalization about $700 million, whereas this company is about $8 billion capitalization, and it has only 250 outlets, whereas Asana has about 4,000 outlets. So imagine the difference. So this company doesn't have these risks as all other retailers have, because the problem with the majority of retailers was that they had to run the same level of expenses or lease or just taking those property, where HBI, Hanesbrands, doesn't have this expense. So they don't care. If they sell their product as a wholesalers to some other company which owns the shop and then sell it, they don't really care if they are profitable or not. They're making money by selling their products, that's it. And that's quite different from other companies which are in that specific industry. Okay, so guys, is it all clear about that specific industry? If yes, put pluses. If you can add something, please do. I'd be happy to hear your kind of opinion on that point as well. So I've just added that. All right, so let's have a look at this specific company. Value line report. Just curious, who analyzed that company already? And put minuses who didn't do it. I put the value line report. Okay, Max did. Dory didn't. Jonas did. Nona didn't. Okay, Gina didn't. All right, so 2 people did. Okay, great. So let's have a look. So here it's recent price $23. In reality, now the price is $19.75. It was closed last night. So PE was 11 at that price. So now PE is around 10. So it's quite low PE. Then we look at the timeline. So if you compare with the market, like Dow Jones or S&P has about 25 PE now. So it's like 2.5 times less than PE of S&P 500. Now, although that value line still says us that timeliness is only 3. So it's like average growth during next 12 months, which I maybe not fully agree. We will see. Like, so value line in majority of cases, right? But we can have our own opinion. But at the same time, value line says that it sees the prices between $30 and $45 within the next 3 to 5 year period. Okay, and if it goes there, so it's going to represent 10 to 20% growth rate, annual growth rate. So in total, it would be 30 to 95. So please remember those numbers. We're going to compare them with our numbers when we perform our 4x4 analysis. Okay. Now we can see that dividends. If you look at Australian market, 2.8%. It's not that much. But if you look at US market, 2.8%. Now it's 3%. Like considering the price drop down, it's quite good. Okay, they didn't pay dividends all the way, so we can see they started only in 2013, and those dividends are constantly growing. All right, so let's have a look at some interesting aspects of this specific business. So first of all, let's have a look at like depression area, like 2008, 2009, because if we expect that some bad stuff might happen with the economy, how the company behaved itself during that time. And we're going to look at two parameters. One parameter is fundamentals, like the profitability of the company itself, and second one, the price. And let's have a look first. Sales. So 2007, $11.75 per share, then $11.36, then $10.20, and then again $11.20, $11.80, and started growing. So what we can see here, slight drop. Right, so we can see that here it dropped like 40 cents, 4%. Here it dropped another 16 cents, which is 1.6% or 16%. Sorry. And but when we look at the profitability during this year, the profitability has actually increased. The earnings, you can see from 33 cents per share, it's moved up to 52% per share, and then it's dropped to 42 cents. So 20% drop of earnings from 2008 to 2009. So it's not that big drop, 20%. If you look, okay, before I tell you that, but look at the price. What happens with the price? The price in 2000 was $8.40 at the highest, $9.40, and it's dropped to $1.30. So why do you think that the earnings dropped only 20%, but the price of the share dropped like what? 6 times, right? More than 6 times, nearly 7 times. Why do you think it happened? What's the reason for such a huge drop in price of the share? Come on, guys, put your opinion. Overall market dropped as well, panic, absolutely correct. Remember that people, they don't read these reports. So few people do, guys, what you do right now. Majority of them, they even don't look at this. And if you go back to 2008, you will see that a lot of companies in retail industry, they were losing money, first of all, a lot of them. Some of them, they had their earnings dropped from, let's say, nearly 80%. So, for example, if company was making $1, it would make only 20 cents or 10 cents, like 80 to 90% in their profitability. Whereas this company had only 20% drop. And again, the reason we already discussed, because this company has different business model. They don't have this huge level of expense which other companies have. Okay, and that's why it could sustain it. But the price still dropped quite a lot. So it represented a fantastic opportunity to buy it there. Okay, just have a look. So if the price was $1.30 at one point, I don't know how long it was there at that time, but if we assume that it was $1.30, and the profit on that year was 42 cents. So what was PE ratio at that moment? Who can calculate it? What's the PE ratio was at certain moment during that year? No, $1.30 divided by 42, not vice versa. 3, correct. So just close to 3. So it means that if you bought this at $1.30, it took you only 3 years to pay that money back. Like, I mean, if the company was totally yours, like 100% yours. Imagine that was the probably best time to buy. So, and I presume that's happened just because people didn't pay attention. But I don't think it was quite a long time, because if you look at average PE ratio here at that day, it was 10. So because we can see it was at a certain point $6.7 on that year, sometimes 1.3. Okay, so what happened after that? We can see that $11.20 or $10.20, $11.20, $11.80, $11.50. A tiny drop here, 40 cents. Then like 4%. Then we can see a growth to $11.60, $13.20, $14.60, $15.90. This year they're going to show $70.80, so more. Next year they're going to show more, and then again they show more. Similar situation happens if we look at sales as a whole company. Okay, similar situation. So we can see that here was a slight drop from 4,600,000,000 to 4,500,000,000, but then it was again 4.6, 5.3, 5.7, 6 billion. This year they are planning to close 6.5 billion, and then 6.7 billion and 7.5 billion. So we can see that sales level is growing. Okay, for us more important earnings. Let's have a look what happens with earnings. And we can see there was a slight 1 cent drop here, nearly flat, 6.7 to 6.66 cents, and then $98, $40, $60, $80, $2, $2.15. So we can see the constant growth for during the last 5 years. Similar situation if you look at net profit, absolutely the same, 398 million, 570, 600 and 711 and 735 this year. So also it shows growth in sales and in earnings. And actually, if you look at earnings per share, it's growing faster. And the reason for that, because they are buying back shares. It was 400 million shares here, 390 here, 378 here, 365 this year, and then 360 and then 350. They just got another approval to buy 40 million worth shares. Okay, so the market. So it means that profitability per share will be growing fast. So guys, the question is why the company went from 34 bucks to $20. We can see that share, like profit is growing, sales is growing. Why? Why the share price drop? That's correct. That is, we will come back to that. But still, the more important part is profit, right? And that is always was the part of this company. The predictability was incorrect. We'll look at this yet. You have some points there. So generally what happened here, it's again similar situation as what's here. Remember that we looked at retailers for the last 1.5 years. Majority of retailers, they showed their sales wasn't growing, they were going down. Their earnings were going down. Some of companies, they had like a smaller drop, some of them bigger drop. Some of them, they're already showing like 2 years lowering in the sales level and everything. Correct, absolutely correct, Dory. They were scared by Amazon. So, for the last 1.5 years, a lot of retailers, they so undervalued. Like some companies, like I know right now, they're sold with PE5. Yes, their sales going down, their earnings going down, but still profitable company. And their sales, like PE ratio is just 5, which is nothing if you're comparing with the industry, like the index and stuff like that. That's why it wasn't surprising for me when course jumped from our masterclass and now it's 45% higher. When Skechers jumped 25% on earnings. When Buckle couple, like for the last week, it's like for the last 1.5 months, it moved from $13 and now it's 21. So imagine like 80% on a half month. And the reason is because the general industry, if you look like in general industry, it start moving up. So it's improving. I didn't actually show you the, I don't know if I showed you the industry. For whatever reason, I'm missing the slide about the industry. But it tells us that right now, for the last 3 months, all retailers, they're improving themselves. And people changing their opinion towards retailers. They understand now that retailers are not going to go like off the business because of Amazon. They're still making money, a lot of companies, and they're still growing. And that's why the most strongest companies, they start moving up. Like Nike, it isn't given to go down, it just stayed flat between like $50 and $60. Whereas some companies, like they really jumped up quite a lot. So I believe, like my opinion again, so guys, you have to make your own opinion, that Hanesbrands represents one of those companies which have a strong growth in sales and earnings, but right now it's quite low in price. And let's have a look why I think so. Now, if we look at earnings, of $2 right now. Okay, and the price is about $20 below. So it means that PE ratio is about 10. Okay, and look how many times the company was priced like that. We can see that it was priced in 2009 when the earnings dropped, and also it's priced when it was flat in earnings, so 10 and 11. Majority of time for the last several years, it was varying from 14, nearly 14, to nearly 19. So it means that if the company was making $1, here people were happy to pay $10 for that company, and here they were paying $18, $14, $16. Right now they are paying again $10 for $1 profit in that company. So at the moment they're as depressed towards this company as they were in 2009. But the company is making constant growth. It doesn't grow going down in price. So the question is why. Okay, and we already analyzed that the reason mostly because of general attitude to retailers, and that's just started to change, and we're going to look at this in more details. Now, another thing which Dory, I think, mentioned is debt. Debt level is quite high, so it's $4 billion and $8.4 capitalization of the company. So it's nearly half of it. So quite huge level of debt. Now, for us, it's important to understand, okay, if the company has this debt, how do they manage with that specific debt? So it's not like it is important the level of that, but more important how they manage with it. So let's have a look at few parameters. Now, first, at return on total capital. Okay, so it's including debt. So they have 16%, 20%, 20% here, 16% planning here. So what it means that if they borrow $1 million, they're going to make, so they invest that money and they make about $160,000. So 16% return. Now, if the interest rate right now, if they're paying 3 to 4%, so if they borrow $1 million, they pay interest $30,000, but they make $160,000. Is it good or not good? Is it good debt or bad debt? So if you know how they allocate properly their cash, it's a very, very good thing. If you saw that here total capital would be like 1, 2, 3%, that would be the risk, because it means that they are borrowing money, but the money doesn't work well for them. So okay, that's good part. Okay, they know how to invest their capital. The next one, how compare like their profit. Yeah, correct. As long as the interest rate is not jumping up quite a lot. Okay, it's moving up, but still. So let's have a look. Can they pay the debt? How sustainable this debt? So if we look at 735 million of profit this year planning, and maybe 960 million next year. So if we look at this particular profit, it keeps it in the same way, $700 million. How many years it will take them to pay all the debt? 6 years, correct? Less than 6 years. So if they use all the cash in order to pay it, like I mean all the profit. But then look at the interesting thing. Their cash flow. You see this cash flow? Dory, look at this. They have more cash coming to the company than they have their earnings. So, and it's about 15% higher because it's $2 earnings and 2.35 dollars in cash flow, cash inflow. So, and so if you look at 15% higher and then add 15% to 735 million, it's about another $100 million extra cash. So it means that they will have more than $840 million cash only this year coming to the company. So if we calculate based on that, we understand that it would be enough 5 years or maybe even less to pay whole debt for this specific company. Where do they get cash? Because they have some expenses like which are not cash expenses. For example, depreciation, one of them. So if you have some assets and you depreciate them, another one is they are writing off goodwill. So when they buy companies, and this specific company, they're constantly growing by buying other businesses. So when that's why they have a lot of borrowed like loans, because when they buy some companies, they have to borrow 1 billion or whatever, and then they pay it off, and then they borrow again to buy another business. Okay, that's the way to do. But when they write off this goodwill, because why do you need the goodwill on your account? You don't need it, right? So you write it off, but you show it as to minimize your taxes, but in reality, you don't have this loss as it is. Okay, so it's already expense. So this is kind of stuff happens like that. Okay, now what did they want to show you? Book value. Book value is here shown as a $3.70. In reality, it's negative because they have huge level of like not intangible assets, and that's actually brings the book value to negative. So that's the second thing which is negative for that specific company. First, it's high level of debt, but it's manageable, and then they have quite high intangible assets. So if the company for whatever reason decides to get bankruptcy, so we won't see, as investors, if we buy the shares, you won't see anything there because they won't have any assets left after they pay all the liabilities. Okay, and then you can see that the long-term debt, you can see it's increased. So it was 1.6 billion, 2.2 billion, and 2016 it jumped to 3.5 billion. And they're planning to have 3.7 billion this year, but then it's going to go slow down. They are planning to pay 3.5 and 3 billion, and kind of lower down. And the reason is just they recently bought a new company, a new chain. So when they're buying, having this expense. Now, if we look at the part, that's exactly what I was saying. Whereas here, I think the value line was saying that they're planning to have about 850 million in cash, 225 a share. See, so it's higher than the earnings of $200 a share. Now, that's their growth rate. Look, the sales were growing 5.5% during the last 5 years, whereas earnings were growing 25%, which is pretty good. We're always trying to find companies where earnings growing faster than sales. It means that the company optimizing their expenses in a way that allow them to have higher profitability with increase of sales. And if you look at like back here, margin, operating margin, and net profit margin, where is it? Net profit margin. It's not here. Okay. I know, net profit margin. So we can see that it's 5, then 8, then 10, then 11. Okay, and they're planning to bring it to 12. So they're increasing their margin, which is pretty good. Okay, because we looked at a lot of companies in the retail industry, and we could see that their margin actually was squeezed, so they were going down instead of going up. So that's another advantage for this company. So when the whole industry was in recession, it kept growing. Okay, and maybe actually that's why they're buying other brands right now, because those brands they cannot operate properly, and this company has the skills, so that's why they're buying them. Okay, and they're planning in the future to have 6.5% growth in sales and 9% growth in earnings. That's actually where it's going to lose some points in our analysis, because there's earnings growth and sales growth less than 10%. Okay, but still, again, they're showing the earnings growth faster than sales growing. Also, they're going to grow in dividends, 14%, so they will increase their dividends, so which is good. Now, if you look at earnings per share, it has seasonality. Okay, so if we look at the graph, you can see the green line. You can see if green line, it's actual, okay, what the company, and another it's estimates. And when you like move your mouse close to this point dots, you will see actually who did those estimates. Okay, and you can see that last earnings, okay, they had company itself, they had like 60 cents in the estimates, and actually company guidance, you see 60 cents, and they made 60 cents. So they earned exactly what they promised. The question is why the share price dropped from $22 to like 90, nearly lost them $90. So why did it drop nearly 15% despite the earnings were exactly as they promised? So, and you see sometimes it doesn't get here. Here, for example, it was lower than estimates. Here it was higher than estimates. Here it was again lower. Here is lower. Here is about the same. Here is about the same. So that's why the prices can go up and down. But if you look in general trend, you can see that those low seasons each year is making more money and more money, and the high seasons they're still making more money as well. So we can see that the company is growing. And then also it's kind of website called Estimize, and you can click on revenue and you can see it graphically as well like that. So it's pretty convenient. Recently I started using it. So if you want to guys, you can use it as well. You just register, it's free for certain parameters. Okay. Now, what will you tell me? Like especially those guys who didn't analyze that company. So how many points do we get here? Roughly, what can you tell? Out of 52 points, where do you think it will stand? You don't have to be precise, just make your opinion. Is it a good, solid company, average company, bad company? Okay, 40, 45. Yeah, Dory, you're correct. So that's 36 points. Now, it is a strong tree, so it's not for company by quality, but it's a strong tree. When we see a tree, we always have to understand where it is losing its points. First, industry rank. So it's losing 3 points here. Now, remember when we discussed about industry, it is in this specific industry, but business model is very different. Value line, when they place the industry ranking, they assess whole industry. But as we can see that this specific company actually is using the situation to expand and it keeps making money. So I would rather not pay attention to that specific rank, maybe to add 3 points back. Okay, despite that industry rank, I think it's 80, so it's quite low, the lowest, okay, industry rank here. So I can add a 3. So if I add a 3, so it would be already 39. Another one is timeliness. Despite the line saying that it's going to grow to nearly like $30 to $40, so it's like 50%, it still puts timeliness rank 3, so it's like average. Okay, yeah, maybe they're right, maybe it's not going to grow that much during next year. Okay, so maybe we'll look like that. Then debt level. Debt level is we're losing 4 points here, so it's quite bad stuff. But at the same time, when I just looked at this, the debt is quite manageable. So they are not going to suffer because of that quite a lot. So I would be probably inclined to like some kind of release on that one. Okay, and then the growth trend. We see that they are lost in growth trend because they grow lower than 10% on sales for the last 5 years and lower prediction on the future growth. But I like the earnings growth, 20%, 25% in earnings growth. So, and who knows, maybe in the future they will show same type of growth. Management is solid, good. So when I add even 1 point in each losing points, I get 40 here. So like assuming, still it's strong 3. And this company can be in a portfolio if you don't have right now anything better than that. Okay, so pay attention to this. Now, okay, price wise. So the price wise, it's got maximum points 52, and so it's now on a huge discount. And let's have a look how we calculate it, and we'll go through the table again. So I took the highest points, so during last 5 years, add them together, divided by 5, and I got average high. And then I did exactly the same with the lowest points during each year, lowest price, add the prices together and divided by 5, and that's what I got $15.50 is a low price, like an average. And then I took earnings per share, added together, divided by 5, and got $1.3. So, and then we need to distinguish, okay, in average, when people were happy, when people are excited about this company, how much were they going to pay for this company, what the multiple was. So we need to divide 24 by $1.30, and that's what we get, 18 times. So when everything is rosy, they're paying 80 times higher than earnings of the company. Okay, and then we need to look at the depression time. Okay, when people are not happy about the company, when they're stressed about it, they're not sure what is going to happen. So within the last 5 years, we need to divide the lowest prices to the same earnings. So, and we get 11.8 P ratio. And at the moment we know it's 10. So it's actually lower than the lowest average within the last 5 years. So people now, they're depressed more than an average during the last 5 years. So, okay, we distinguish these prices. Then we have to like calculate, okay, fine. What if the company again become favorable? People again start liking this company. They again would be all excited about this company. And they're going to pay 18 times higher their earnings. What's the earnings going to be? So we look at PE ratio or earnings. Company estimates that it's going to make $2.7. So we multiply 18.6 on 2.7, and we get $51.27. So it means that we can expect that this company is going to be sometimes in the future, it might go to $51. Okay, that would be the kind of highest point. Now, and then we need to look at the lowest point. So, and we're going to look at last year earnings, even though this year earnings was already about $2. So it's higher. We're still going to last year earnings, 1.8. Imagine that company is going to go flat. And then they're going to be paying these depressed multiples. So the prices has to be about $21.80. But now, right now, price, if you go to the market, is $19.75. So it's actually lower than that point. Now, when we see these 2 points, the lowest, the highest, we divide them by 3 slices because we believe that 30%, like 1/3 of the time, is going to be the highest points, closer to high, 1/3 of the time closer to low, and 1/3 somewhere in the middle. Okay, and that's how we distinguish those levels. So we just divide this by 3 and then slices $9.8, and then we can see. So our buying range would be somewhere in between 21 to 31. Our holding range would be between 31 and 41. And then the sale range is going to be between 41 and 51. Now, who remembers now where value line like predicted the share is going to go to? What prices? 30 to 40, right? So 45 on, yes, so when did it go? 30 to 45, that's correct, Dory. So similar to our, right? So this range. So not exactly the same, but we'll do that now. So that's what we can expect, and that's where I showed you that tangible book value is -$3. Next earnings going to be in February, 1st of February. So we have plenty of time to play around with this company. There are not probably going to be any surprises right now. Okay, so we can expect to grow. Okay, clear about this specific fundamental analysis, or do you have any questions? Okay. That's how we distinguish the price based on fundamental analysis. Now we go to the technical analysis and trying to find the perfect moment for entry. Actually, last month, I think, who was it? Gina, probably. You were at the meeting where we went for social meetup, where the guy from like Australian stock market, he came and he said that he's buying companies based only on fundamentals. And his like performance is quite nice, and he doesn't even bother to look. He doesn't know how to analyze companies technically, but he buy companies based on fundamentals. So I don't know, Gina, were you at that meeting or another meeting? I don't remember specifically. I remember you were at one of them. But that's the interesting. That's how, yeah, perfect. Yeah. So and that's how people distinguish the price of entry. And he would buy if the price is lower to this level. He would just buy it. Doesn't bother about, you know, the rest of it. Yeah, correct, Dory. A lot of them, a lot of, and especially imagine if you're big and you're buying for $1 billion, you can't rely on technical analysis, because when you buy like stock worth $1 billion, you're going to move price. Technicals wouldn't work for you. Okay, so you have to find a way how to find, like, you know, so lie to all the small investors, have to come up with bad news or stuff like that, and then use this bad news in order to purchase that stock. Okay.